This is the moment everything shifted, not slowly, not symbolically, but decisively. Today marks the point where the structure of global precious metals pricing stopped being theoretical and started becoming visibly fractured. What happened was not a rumor, not speculation, not interpretation. It was a formal regulatory move that most Western financial outlets are choosing to treat as minor when it is anything but. India's Securities and Exchange Board issued a directive that fundamentally changes how gold and silver are valued inside one of the largest physical bullion markets on Earth. Beginning April 1st, all mutual funds and exchange-traded funds in India that hold physical gold and silver must value those holdings using domestic spot prices sourced from recognized Indian exchanges, not London benchmarks, not LBMA reference rates converted into rupees with layered adjustments, not Western paper prices adjusted for duties and premiums. Domestic Indian spot prices reflecting actual local supply and demand conditions. Pause and think about that carefully. For decades, the London Bullion Market Association has functioned as the central authority for global precious metals price discovery. Every major institution, every multinational bank, every fund manager across continents has referenced London pricing as the anchor. That system just lost authority over a nation of 1.4 billion people, a country that represents the largest physical gold demand market in the world and one of the most significant silver consumers anywhere. On the same day, the Reserve Bank of India confirmed implementation details, allowing silver to be used as official loan collateral under new lending rules effective April 1st. At the same time, Indian equity funds managing approximately 30 lakh crore rupees received expanded permission to allocate capital into physical gold and silver. These are not isolated adjustments, they are structural moves. Before going deeper, understand what changed in practical terms. Previously, Indian funds were required to reference LBMA fixing prices, then adjust those prices for currency conversion, import duties, transportation costs, and local premiums. That process created layers of opacity. It built distance between what Indian investors actually paid and what London declared as value. Starting April 1st, that separation ends. Indian gold and silver ETFs will reflect what metal actually trades for inside India. The Multi-Commodity Exchange of India, MCX, which handles physical derivative settlement, becomes central to valuation. That means price discovery inside the largest physical demand market begins standing on its own foundation, rather than leaning on Western benchmarks. The implications are not symbolic. When the largest physical gold importer in the world decides that foreign pricing mechanisms no longer reflect domestic reality, it signals distrust of the old system. India imports more gold annually than any other nation. Its silver consumption rivals China's. And India has effectively said that London pricing does not represent local supply and demand dynamics accurately enough to continue serving as the valuation anchor for its fund industry. That is not a minor compliance update. That is fragmentation beginning in plain sight. Now consider the timing. This directive arrived just 48 hours after the CME halted metals trading for 90 minutes during a silver breakout. Silver had been approaching resistance. Momentum was building. Then trading paused under the explanation of technical issues. When trading resumed, price dropped sharply and momentum reset. 2 days later, India announces it is moving away from Western pricing benchmarks. Whether coincidence or pattern, the sequence matters, especially when viewed alongside broader developments. India has been aggressively accumulating gold at the central bank level for several years. The Reserve Bank of India has added substantial tonnage to its reserves and repatriated metal from foreign vaults back into domestic custody. China has followed similar strategies, strengthening domestic exchange infrastructure and reducing reliance on Western financial systems. Both nations have been positioning for independent price discovery. When Shanghai established its gold exchange and began offering yuan-denominated contracts, many dismissed it as regional. When India began expanding MCX capabilities, critics argued London's dominance would remain intact. Yet Shanghai trades at persistent premiums to Western spot prices, and India has now formalized domestic valuation. Look at the capital flows. In January alone, gold ETFs in India attracted 24,040 crore rupees, more than double the prior month's inflows of 11,647 crore rupees. For the first time, gold ETF inflows exceeded equity fund inflows in India, one of the fastest growing stock markets globally. That is not noise. That is behavioral shift. Silver ETFs added another 9,463 crore rupees in the same period. Combined assets under management for precious metals, ETFs in India now sit at approximately 116 lakh crore rupees, exceeding $13 billion and growing steadily. And beginning April 1st, those assets will be valued using domestic spot prices under India's control, rather than London's benchmarks influenced by Western banking institutions. The Reserve Bank's collateral decision adds another layer. Silver will now qualify as formal loan collateral for banks and non-banking financial companies. The permitted limits include 10 kilograms for ornaments and 500 grams for coins. Bullion bars are excluded for retail lending, but the structure establishes silver as monetizable within the formal financial system. Loan-to-value ratios range from 85% for smaller loans down to 75% for larger ones, with valuations tied to recognized exchange prices or IBJA rates. That shift changes perception. It transforms silver from passive possession into recognized financial asset with liquidity utility. Estimates suggest Indian households hold more than 40,000 tons of silver in jewelry, ornaments, and coins. That amount exceeds total registered silver holdings across Western futures exchange vaults combined. Much of that metal has remained idle for generations, valued culturally and sentimentally. Now it becomes monetizable collateral integrated into formal credit channels. When 1.4 billion people understand that their silver can secure loans, silver transitions from ornamental metal to functional savings instrument. That is remonetization driven by policy rather than market narrative. Simultaneously, equity schemes managing roughly 30 lakh crore rupees received expanded permissions to allocate portions of capital into gold and silver. Even a small percentage reallocation represents significant incremental demand entering markets already experiencing physical tightness. And again, those allocations will reflect domestic pricing rather than LBMA benchmarks. When major population centers begin valuing metal independently, the unified global pricing structure weakens. London's authority depends on universal acceptance. Once key markets price domestically, fragmentation accelerates. Arbitrage requires physical metal movement. If supply is constrained, divergence persists. Shanghai premiums already reflect that reality. India's policy formalizes it. What you are witnessing is not volatility. It is structural reconfiguration. The largest physical demand market on Earth has decided to value precious metals on its own terms. Silver is entering formal banking collateral frameworks. Equity funds are being permitted direct bullion exposure. Massive ETF inflows signal investor behavior shifting toward hard assets. And all of it is happening while Western paper markets show signs of strain. This is not a regional regulatory adjustment. It is a decisive step toward multipolar price discovery in precious metals. The question now is not whether fragmentation is occurring. It is how quickly the consequences unfold once domestic pricing, remonetized silver, and expanded fund allocation converge beginning April 1st. Now step back and connect these developments to the stress signals already visible inside Western markets, because none of this is happening in isolation. The CME halt during the silver breakout was not just a random interruption. Silver was building momentum, approaching a technical threshold that many traders were watching closely. Then trading paused for 90 minutes under the explanation of technical disruption. When the market reopened, price immediately dropped roughly $3, and the breakout attempt was neutralized. Momentum reset, sentiment cooled. 2 days later, India announces that it is effectively stepping away from LBMA-based valuation. Whether coincidence or correlation, the pattern is impossible to ignore. At the same time, Shanghai spot silver has been trading at persistent premiums over Western spot prices, $5, $6, sometimes higher. Under normal arbitrage conditions, that gap should close quickly. Traders would purchase cheaper Western silver, ship it to Shanghai, sell at the premium, and lock in profit until price is equalized. The fact that premiums persist indicates physical constraints. The metal required to close the gap is not easily available in sufficient volume. That is not theory. That is basic market mechanics. Now introduce India's shift into this dynamic. If domestic Indian spot prices begin reflecting local supply and demand independently, and those prices trade above LBMA benchmarks due to physical tightness, Indian ETFs and funds will be valued at the higher domestic rate. That creates incentive for capital and potentially physical metal to flow toward jurisdictions where price discovery reflects stronger demand. It accelerates eastward movement of bullion that Western vaults can ill afford. Look at the registered silver inventory levels in Western futures vaults. Registered stocks have been declining consistently. On one recent day alone, approximately 2.2 million ounces left registered status across multiple vault operators, including Asahi, Brinks, HSBC, JP Morgan, and StoneX. Registered metal represents inventory designated available for delivery against futures contracts. When that category shrinks, it reduces immediate deliverable supply. With the March delivery window approaching, open interest levels remain elevated despite significant contract rolling. The roll of approximately 71 million ounces into later months reduced near-term pressure, but did not eliminate underlying demand. The metal continues leaving registered status regardless of paper positioning. February gold contracts add another layer of tension. Thousands of contracts remained open into the final days of the contract month, representing roughly 12 tons of gold valued around $2 billion. Under normal settlement cycles, those contracts would either roll forward or settle through delivery in orderly fashion. Delays in settlement visibility raise questions about logistical strain. That does not automatically imply default, but it does signal stress in physical settlement processes. Institutional behavior reinforces this picture. Silver ETF inflows have continued even as futures open interest declines. That is not retail speculation. Large players choosing ETF exposure over futures exposure may be signaling counterparty caution. Futures contracts depend on clearing mechanisms and delivery assurances. ETFs hold allocated metal under custodial structures. When institutions prefer ETF accumulation while futures positioning shrinks, it suggests risk assessment shifts beneath the surface. Meanwhile, enforcement actions at the Shanghai Futures Exchange show heightened vigilance. Multiple trading groups faced suspension for position limit violations within a short time frame. Exchanges typically increase enforcement intensity when concentrated positioning threatens systemic balance. Combine enforcement actions in Shanghai, persistent physical premiums, CME halts in the West, declining registered inventories, and now India's formal move toward domestic pricing and silver remonetization. These are not random data points scattered across disconnected systems. They are components of a broader transition. Consider also the scale of Indian household silver holdings. Estimates exceed 40,000 tons in ornaments, coins, and jewelry. That volume surpasses registered silver stocks in Western vaults by a wide margin. Previously, that silver functioned primarily as cultural store of value. Now it becomes formal collateral integrated into the banking system. Even partial monetization changes liquidity dynamics. When households can pledge silver for loans at structured loan-to-value ratios between 75 and 85%, silver becomes active financial capital rather than dormant wealth. At the same time, equity mutual funds managing approximately 30 lakh crore rupees now have expanded permission to allocate into physical gold and silver. Even a conservative 1% reallocation would represent hundreds of billions of rupees in potential bullion demand, and those allocations will reflect domestic valuation metrics rather than foreign benchmarks. When you combine ETF inflows exceeding 24,000 crore rupees in a single month with structural policy shifts allowing broader capital access to bullion, demand pressure intensifies in a market already showing supply constraints. This is where the fragmentation becomes visible. For more than a century, the LBMA and associated Western benchmarks served as the unified reference point for precious metals pricing. That authority depended on widespread acceptance. Once major markets begin pricing independently, global synchronization weakens. Price differentials widen. Arbitrage depends on physical movement. If metal is scarce or tightly held, gaps remain. The London gold pool of the mid-20th century offers a historical reference. That coordinated effort among central banks sought to maintain gold at a fixed level to support monetary stability. It functioned only while participating nations cooperated fully. When France began demanding physical delivery and repatriating gold, the structure destabilized and eventually collapsed. Today's environment differs in scale and structure, but the principle is similar. Price management frameworks rely on unified participation. When major physical demand nations chart independent paths, centralized control weakens. Western paper markets continue operating with high leverage relative to available physical metal. Futures contracts, unallocated accounts, and derivatives expand notional exposure far beyond vault inventory. That structure functions efficiently under normal liquidity conditions, but when physical demand surges and registered inventories decline, the leverage becomes visible. Halts, enforcement actions, and settlement delays become more frequent stress indicators rather than anomalies. India's decisions are not reactive measures taken in isolation. They reflect long-term strategic alignment with broader trends among emerging economies, seeking reduced dependency on Western financial infrastructure. Domestic price discovery, remonetization of silver, and expanded capital allocation into bullion represent coordinated financial positioning. When these shifts occur simultaneously with stress signals in Western exchanges, the timing amplifies significance. Over the coming weeks, several inflection points converge. The March delivery window in Western futures markets approaches. Domestic pricing implementation in India activates April 1st. Silver collateralization becomes operational the same day. Each milestone has potential to reveal strain or confirm structural transition. None guarantee immediate disruption, but collectively they increase probability of divergence between paper pricing and physical market realities. Mainstream coverage frames these developments as localized regulatory updates. That framing understates scale. When the world's largest physical gold importer mandates domestic valuation, that impacts global pricing psychology. When silver gains formal collateral status across a population exceeding 1 billion, that alters demand perception. when equity funds controlling trillions of rupees gain expanded bullion allocation rights that affects capital flows. The cumulative message is clear. Western paper benchmarks no longer enjoy uncontested authority. Eastern markets are building parallel frameworks rooted in physical demand realities. Whether this transition unfolds gradually or accelerates under pressure depends on supply elasticity, capital movement, and institutional response. But fragmentation has begun. The essential point is not prediction, it is recognition. Structural change often appears subtle at first, embedded within regulatory language and technical announcements. Only later does its magnitude become obvious. India's simultaneous pricing reform, silver remonetization, and fund allocation expansion represent foundational adjustments rather than tactical maneuvers. Combined with visible strain inside Western exchanges, they form a coherent pattern pointing toward multipolar price discovery. Markets can delay consequences temporarily through liquidity management, contract rolling, and technical resets. But underlying supply and demand imbalances eventually surface. If physical inventories continue declining while Eastern demand expands under new policy frameworks, divergence will intensify. The global precious metals market may no longer operate under a single pricing authority, but under competing regional mechanisms reflecting different economic realities. That shift does not occur overnight. It unfolds through incremental decisions that collectively redefine structure. Today's developments represent one of those defining increments. The next phase depends on how markets respond when domestic Indian pricing activates, and silver collateral flows begin interacting with institutional allocation channels. Now bring everything together and look at the full structure without distraction. Today we are watching the visible beginning of a pricing system dividing into spheres. Not speculation, not theory, not emotional narrative, but observable policy decisions aligned with measurable market strain. India's regulator has mandated domestic valuation for all gold and silver ETFs. The central bank has formalized silver as bank-recognized collateral. Equity funds managing roughly 30 lakh crore rupees now have expanded authority to allocate into physical precious metals. ETF inflows have already reached record levels, with gold attracting 24,040 crore rupees in a single month and silver adding 9,463 crore rupees. Combined precious metals ETF assets now sit around 1.16 lakh crore rupees and continue rising. All of this shifts into effect beginning April 1st. At the same time, Western exchanges are experiencing persistent stress signals. Registered silver inventories continue trending lower. Multi-million ounce withdrawals are not isolated incidents. February gold contracts have shown unusually high open interest late into the settlement cycle. Shanghai continues trading at sustained premiums above Western spot prices. Enforcement activity on Asian exchanges has increased. The CME halted trading during a silver breakout and price momentum reset immediately upon reopening. These are not identical events, but they move in the same direction. They point toward tightening physical conditions and rising sensitivity inside leveraged paper systems. When a pricing system functions smoothly, arbitrage keeps global values aligned. If one region trades higher, metal flows until equilibrium returns. But that mechanism depends on available supply and frictionless logistics. If vault inventories are limited and physical holders are reluctant to release metal at prevailing paper prices, arbitrage weakens. Premiums persist. Regional divergence grows. Once divergence becomes durable, pricing authority decentralizes. That is the risk facing the long-standing LBMA benchmark structure. The LBMA's influence has rested on global confidence in its daily reference prices. Those prices guided fund valuations, derivatives contracts, wholesale transactions, and retail pricing adjustments across continents. But that authority assumes universal participation. India's policy shift introduces a major exception. China already emphasizes domestic exchanges. Russia prices internally. When several of the world's largest population centers and major physical demand markets move toward sovereign price discovery, the global benchmark becomes one reference among many rather than the singular anchor. Consider the scale again. India represents 1.4 billion people. Household silver holdings are estimated above 40,000 tons. Gold demand consistently ranks among the highest worldwide. Now silver within that system gains formal banking utility. Loan-to-value ratios between 75 and 85% transform dormant metal into active financial leverage. Even if a fraction of households choose to monetize holdings, the psychological shift alone reclassifies silver from ornamental asset to strategic liquidity reserve. When asset perception changes at that scale, accumulation behavior can follow. Equity funds now permitted, expanded bullion allocation represent another layer of structural demand. 30 lakh crore rupees under management is not marginal capital. Even conservative reallocation percentages equate to substantial incremental bullion exposure. And unlike speculative flows, these allocations occur inside regulated investment frameworks. That institutionalization deepens demand durability. Now evaluate how Western markets might respond. Short-term price containment mechanisms can include liquidity injections, contract rolling, volatility halts, or narrative framing through mainstream analysis, but none of those tools replenish physical inventory directly. If registered stocks continue declining and delivery windows approach with elevated open interest, pressure accumulates. Paper contracts can expand notional exposure temporarily, yet confidence depends on deliverability, credibility. If institutions increasingly prefer ETF custody or allocated exposure over futures settlement risk, that signals changing trust dynamics. The historical parallel of coordinated gold price management decades ago illustrates the vulnerability of centralized control when major participants alter behavior. Coordinated systems rely on collective adherence. Once prominent actors shift policy direction, maintaining uniformity becomes increasingly complex. Today's environment is not identical to past gold pool arrangements, but the lesson regarding participation remains relevant. The upcoming convergence of events matters. Domestic pricing activation in India aligns with silver collateral eligibility on the same effective date. Western futures markets move through delivery cycles under tightening inventory conditions. ETF inflows remain elevated. Shanghai premiums persist. None of these elements alone guarantee dramatic immediate price movement. Markets can move sideways while structural forces build beneath the surface, but alignment of policy reform with physical tightness increases sensitivity. Mainstream framing may continue to describe India's changes as localized regulatory refinement. Yet when the largest physical gold importer and one of the largest silver consumers redefines valuation methodology and collateral eligibility simultaneously, the implications extend beyond domestic borders. Capital flows are global. Perception is global. When a major market signals reduced reliance on Western benchmarks, others observe and evaluate alternatives. Verification remains essential. The regulatory circular is publicly accessible. The central bank collateral directive is documented. ETF inflow figures are reported. Vault inventory movements are disclosed in exchange reports. Shanghai premium data is observable. The facts do not require interpretation to exist. Interpretation only connects them into structural narrative. The essential dynamic is this: physical demand in the East continues strengthening under formal policy support, while Western pricing authority relies heavily on leveraged paper instruments. As more markets adopt domestic reference pricing, global synchronization weakens. If physical metal migrates toward regions offering higher valuation and stronger demand, Western vaults face further depletion. If depletion accelerates while contract exposure remains elevated, volatility potential rises. No single announcement created this environment. The foundation has been building for years through central bank accumulation, exchange development, and gradual diversification away from Western financial dependence. Today's announcements accelerate and formalize that trajectory. They put implementation dates on policy direction. They remove ambiguity regarding intent. For individuals and institutions observing precious metals markets, location increasingly matters. Regional pricing divergence affects valuation, liquidity, and arbitrage opportunity. Understanding where benchmarks originate and how domestic markets operate becomes critical. As fragmentation grows, relying solely on one reference price may provide incomplete perspective. The broader monetary system itself shows signs of multipolar evolution. Currency alliances, trade settlements outside traditional reserve channels, and sovereign accumulation of strategic commodities reflect gradual realignment. Precious metals, as foundational monetary assets, naturally sit at the center of that transformation. When pricing authority decentralizes, it reflects deeper economic shifts. What happens next depends on behavior under stress. If physical supply expands sufficiently to meet new demand channels, divergence may remain controlled. If supply remains constrained, while policy-driven demand accelerates, premiums widen and benchmark authority erodes further. Either outcome represents structural transition rather than temporary anomaly. This is not investment advice. It is structural observation. Policy reform in India combined with visible Western exchange strain signals meaningful change in how precious metals are valued and integrated into financial systems. The fragmentation process is not complete, but it is underway. Today marks a clear milestone. Domestic pricing begins. Silver becomes bank-recognized collateral. Equity funds gain bullion allocation flexibility. ETF inflows demonstrate behavioral confirmation. Western paper markets show tightening inventory conditions. Shanghai maintains premium divergence. These components collectively define a system transitioning from centralized benchmark dominance toward multipolar price discovery. The prudent response is not panic or complacency, it is awareness. Monitor primary data. Observe vault reports, ETF flows, premium spreads, and policy implementation outcomes. Recognize that global pricing structures can evolve gradually and then adjust rapidly once thresholds are crossed. The global precious metals market is no longer operating under unquestioned single-center authority. Eastern demand centers are asserting pricing sovereignty. Whether that results in immediate repricing or prolonged divergence remains to be seen, but the trajectory is visible. Stay analytical, stay skeptical, verify independently. The shift is not theoretical, it is structural, and it is unfolding in real time.